Welcome to the 2012 Hedge Fund Compensation Report Summary, brought to you by hedgefundcompensationreport.com, a division of Job Search Digest. In our many years publishing the annual compensation report, we've seen significant changes in how compensation works. We feel a responsibility to present a compensation benchmark that is comprehensive, reliable, and affordable. The Hedge Fund Compensation Report has grown to become the most comprehensive benchmark for hedge fund comp in the industry. Over the years, the report has grown, and we now have more than 40 detailed charts and graphs included, and they should provide you with all the information you need to better understand comp practices in the hedge fund industry. This report analyzes data related to cash comp, levels of equity sharing, work satisfaction, and much more. It also seeks to clarify fund performance and how that relates to pay expectations. So let's talk about our methodology a little bit. Our goal, again, is to create an accurate and affordable industry benchmark, and we do that by surveying hundreds of professionals from within the industry. So it's not based on anecdotal evidence or a small sample. Firms both large and small are represented, and we see that the typical hedge fund firm is in fact small, with less than 50 employees. We get responses from all over the world, with a primary concentration in North America. And all personally identifying information is always kept confidential. 2 years ago, we reported that in a fairly pessimistic hedge fund industry, only 46% of respondents expected a higher income. Last year, 53% of those surveyed expected some improvement, so we saw an increase there. This year, however, some of that pessimism is back, as only 41% of hedge fund employees expect to make more money in 2011 than they received in 2010. 40% expect flat pay, while almost 1 in 5 expect a pay cut. What are the primary drivers of compensation? Every year we take a look at this, and we always have consistent findings here. It's based on experience, fund performance, and the size of the fund. These are the three primary drivers. Now, regarding fund size, bigger is not always better, and we've seen some variation there. And although the hedge fund industry is often referred to as a meritocracy, there is a disconnect between individual performance and fund performance. And one thing to keep in mind, common titles such as analyst, director, risk manager can and do mean very different things to different firms. And this is especially true at the smaller firms, where each person tends to wear more hats than their larger firm counterparts. One near constant from 2010 to 2011 was the size of the fund at which people worked. Considering how much pay can vary by this factor, this is an important point to note. About 1/3 were in firms where the most recently raised fund was less than 100 million, and a quarter where the most recent fund was 100 to 500 million. And in the search for higher compensation, some believe that the larger the fund, the higher rewards. And although we don't see that as a constant, it does tend to be the case. Larger funds with a small number of staff have a decided advantage over those in similar size groups in the recruiting process. These funds can demonstrate a clear business case for upside to those candidates, and it gives them an advantage in the war on talent. Last year, 45% of hedge fund professionals reported double-digit positive returns for their fund. This year, that number dropped to only 16%. The number expecting their funds to be down 10% or less went from 3% last year to 22% this year. And only 4% expect their fund's performance to sink by double digits. Now, it's worth noting, last year, not a single respondent expected that level of decline. So things have definitely changed. A consistent finding in the hedge fund compensation report is that the higher the overall earnings, the more bonus matters. Without exception, each pay range tier expects a larger percentage of its total income to come from bonus payouts. Last year, those making $1 million or more expected 87% of their earnings to come from bonus. Now, that figure is 83%. As reported last year, guaranteed bonuses are far from the norm. 4 out of 5 hedge fund employees have their entire bonus at risk. And some of the bonus at risk does not even get rewarded in discretionary income. 14% of respondents said that they had to invest some of their bonus back into the fund. Now, there's no better incentive, of course, than to share in the equity. Even so, the majority of people working for hedge funds have no ownership stake at all in their funds. The report also shows that the highest level positions in a hedge fund are willing to take smaller cash compensation in return for equity. Only 29% of hedge fund employees surveyed had any equity share in 2011, and that's down slightly from last year. Unexpectedly, the proportion is even lower in North America and Western Europe, where 27% participate in the upside. None of the 2011 respondents with less than 2 years of work experience claimed to have any equity. Those with 15 to 19 years experience were the most probable at 46%. When asked specifically about their hedge fund experience, rather than just general work experience, fully 2/3 of those with 20 years or more were granted equity. Now, I mentioned earlier that there are a significant number of graphs and charts that are in the report, and here's that full list. In fact, there's 43 in total that cover everything from the base and bonus details to breaking out the different levels of base and bonus payout by title, by fund performance, and fund size. There's quite a bit of detail available here. I invite you to check out hedgefundcompensationreport.com. There you can get instant access to the full report and even download a sample report. On behalf of all of us who took great care in creating the Hedge Fund Compensation Report, I'd like to thank you for your time and your interest, and we hope this video was helpful.